Are you a swing or position trader and want to learn how to protect your positions from sharp downside moves at little to no cost? Well, today I'm going to show you how to sell options around your positions using the charts to give you downside protection and peace of mind. Stay tuned. It's mastertrader.com. I'm Dan Gibby at Master Trader, and I've been actively trading options for over 25 years. Be sure to subscribe to our Chart of the Week and YouTube channel if you want to learn how to make money investing and trading in the markets. Today I'm going to explain the benefits of an option collar and show you how to trade them around your positions for maximum profit. Okay, let's get started. Here's a daily chart of Estee Lauder, and we're just going to use this as an example that it's a bullish investment for you, whether swing trade or position trade where you want to hold it many months. But the lesson on the collar is you want some downside protection without just buying a put alone, which costs money. So this is a beautiful pattern. Had a breakdown failure here. This was a bullish gap. We have rising 20, rising 50, nice wide range bar. If you weren't concerned about downside protection or a gap against you, then you wouldn't do this trade because this trade looks great for higher prices. Here's our collar definition. We're going to sell out of the money calls and we're going to buy out of the money puts. You buy one contract for each 100 shares that you own of the stock. When you're selling an out of the money call, you're giving somebody the right but not the obligation to buy your stock from you at the agreed upon strike price on or before expiration. And then you're going to take the premium from that and buy an out of the money put. So that out of the money put is your downside protection with the break-even points. We use this strategy to limit your downside risk at little to no cost, because if you do it right, it should pay for itself. And using the charts, you can actually put this on for a credit, so you're getting paid to put the position on. So it's a partial hedging strategy. We're capping our gains at the short call strike price plus any premium we received, but we're limiting our losses. And then you manage the strikes and the expiration with the charts and your own trading plan, which we obviously teach. This is the risk graph of this position. So unprotected portfolio, this is just if you are long Estee Lauder. You're going to make money if it goes up, you're going to lose money if it goes down. So here's how we've used this strategy to limit our potential risk. On the next slide, I'm going to show you some actual numbers, but this is just visually shows you the risk to reward profile of this option collar. We're capping our gains, as mentioned, to that upper strike plus any premium received. But if we have a catastrophic down move or gap down, we're limiting our losses to the put that we purchased. Here's an example with real numbers. And there's a trade-off of which month you use and which strike prices. It's a trade-off of how active you want to be managing and how much cushion you want per the charts. In terms of the expiration, we recommend you can do this 1 to 3 months out so you can manage it with the charts. And just remember that this is a bullish position to you. It's a long-term investment, so you don't want to fully cap your upside, but you're willing to cap a little bit in exchange for the disaster insurance. Here's an example. We're going to sell the 120 calls, buy the $100 put. So we're going $10 up, $10 down. With 33 days to expiration, this is the trade that you would put on, and you're actually putting it on for a credit. So if you had 1,000 shares, $400 would hit your pocket. If you say, I'm okay with buying 3 months of insurance, I don't want to have to manage this thing day by day, I like the same strike prices, but just give me 95 days, this is the midpoint 25-cent credit. Should you use them? Let's think about who this benefits. Remember, you're buying insurance. Downside protection costs money. You can either buy that protection, but it's going to cost you, and what it costs you is it's going to reduce from your future gains because it's going to be added to your cost base. You can just compare this to just stop out of the stock. Use your stop losses based on the chart, and instead of worrying about buying insurance, just get out of the position. So it's really more for the disaster gap situation. Another strategy we teach, and we have a number of hedge fund and family office clients, we deploy an option layover strategy with the intent of not to disturb their positions, but to overlay option writing to generate additional monthly revenue through time decay of short options. And then that over time continuously lowers your cost basis. So if you do get some disaster gap, your cost basis is significantly lower at that point in time. So again, it just protects from massive sell-offs and gaps. Like, earnings might be coming up and you don't know if this thing's going to gap up or down. Finally, just discuss this if you deploy any short call strategy on your long-term positions. Discuss the tax ramifications with your CPA, because you don't want your stock to get assigned, taken away from you, and then all of a sudden you might have a tax issue that you didn't know about. Just wanted to highlight the Master Trader Option Strategy series. It goes into everything A to Z, great detail. We teach you directional trades, these income generating trades in all market environments. We show you how to deploy these on your own, of course, and put the odds in your favor, which are superior to trading stocks alone. That's all for this video. Be sure to subscribe to our YouTube channel and check out our option trading advisory letters on our website if you're serious about wanting to make money investing and trading in the markets. And keep watching these videos on our channels. We've got tons of great content to help you learn our simple approach of generating wealth in the markets. Thanks so much for watching. Happy trading, and see you next time.